Okay.
Right. So warm greetings to all of you colleagues. Welcome to our lecture 13. This is video A in the 2024 academic year. So previously, we were looking at the concept around capital allowances. So I just want to quickly open a certain document of notes that I shared with you in that particular session, just so that we can be on the same page before I indulge in what I would like to channel your focus on for tonight's engagement. So I'm going to quickly open the notes on capital allowances that I discussed with you guys last week. Right, so these are your notes on capital allowances that we looked into last week. So obviously we covered about the concept of your section 11E capital allowances, which is wear and tear. We also looked at the section 12C capital allowances, which is mostly applicable to machinery that are used for production purposes. That is if the type of a taxpayer in question is a normal company other than an SME or an SMB, small business organization. That's where section 12C would apply. Then there's section 12E capital allowances, right? Section 12E capital allowances usually is applicable when you're dealing with small business organizations, and they give you or provide you with at least two provisions there, where if you're dealing with a manufacturing asset, a manufacturing machinery, normally it would be like SARS would allow you 100% provision for capital allowances under those circumstances. And then if it's a non-manufacturing asset, very important, here is the catch. In year one, SARS allows you 50% of the cost price of that asset. But remember, there is a catch. There is a catch to it. So here is the catch. For assets less than 7,000 rands. In other words, if the non-manufacturing asset in question, if the value is less than 7,000 rands, here are the consequences to that. Therefore, section 11E, wear and tear provisions would apply. But remember, also take note of what I'm about to put in brackets: no apportionment to be done. You don't apportion. That is if the non-manufacturing asset in question is less than the value of 7,000 rands. So here's what you do. You would apply the provisions of section 11E, wear and tear, without apportioning for the capital allowances in that case. And that was the example that we looked at. Let me just quickly go to the part that we were looking at. I'll be able to tell you now. Okay. That was this example here that we looked at here. This one right there. 7.9, wear and tear allowances. No, not this one, sorry, my apologies. It should be the one about the, what is it, section 11E capital allowances. So I'm just looking for that real quick, if you may allow me. Should be, yeah, it is this particular example. Yeah, because here they were dealing with section 12E assets, whereby the taxpayer in question is a small business corporation or small business enterprise. So what would happen is exactly as I had summarized it for you. For manufacturing assets, what would happen is SARS would give you 100%. It would give you 100% claim on the cost price of that asset as your capital allowance for manufacturing assets. Then with non-manufacturing assets, what SARS does, they would allow you to deduct 50% of the purchase price in year 1, followed by 30% in year 2, and then 20% in year number 3. So those were Section 12E provisions. And then I did mention that there is a catch, especially when you're dealing with non-manufacturing assets under the provisions of Section 12E type of assets. And the catch, you saw it actually in this example that I illustrated to you, whereby we were given here that XCC is 100% owned by Mr. Q and is a small business corporation. Its statement of comprehensive income for the year ended 28 Feb was this, provided as follows. So we did notice that, okay, there was depreciation that was computed here on furniture and office equipment. Now, furniture and office equipment in the books of XCC, which is a small business enterprise, would be seen as non-manufacturing asset. So it falls within this group. So what we would have expected normally, if the asset's value is above 7,000, we would have applied these provisions. But however, we noticed that when we then went into the breakdown of the furniture and office equipment that was acquired here, we noticed that the furniture consisted of an office chair to the value of 3,000. And then there was a filing cabinet that costed the company 27,000 rands. So from the two furniture or office equipment that we can see, there are two types here. One is an office chair with a value that is 3,000 rands. And notice this amount, going back to the catch that I was showing here, but anyways, you also see that catch here where they do give you some explanations. All right, where they give you some explanations here. There's a note, I think note 7.8 that they would give you somewhere here. I'm just trying to look for it. Yeah, over here. This is the note where they say small items costing less than 7,000 may be written off in full during the year of purchase. Remember to consider this when you claim Section 11E allowances. All right. So now if you look at the example that we had, because the amount of this particular office equipment, though we were dealing with a small business enterprise as the taxpayer, the value of this office chair is less than 7,000 rand. So what do? Section 11E provisions would apply. That's what I was explaining here. To say for assets less than 7,000 rands. Therefore, Section 11E wear and tear provisions would apply. And there's no apportionment here. So if the value of that asset is less than 7,000 rands, SARS would give you a full deduction. Or a full, let me just put it this way, a full capital allowances claim on such assets. And that's the typical example that we saw here. Let me go back to this. So that's the typical example that we saw with the office chair. It's less than 3,000 rands. So what is that is supposed to happen first? First of all, Section 11E provisions would have to be applied, number one. And number two, because the value is less than 7,000 rands, hence you notice here on the office chair, the capital allowances consequences resulted in a full deduction of the purchase price of 3,000 rands that you had over there. But then for the other part, because the amount of this office equipment, which is in form of a filing cabinet, it's more than 7,000 rands. So guess what happens? No Section 11E provisions would apply. What would have to then be applied is these provisions of Section 12E, whereby in the year of purchase, you get 50%, of the purchase price, and in year 2, 30, and then followed by the 20% in year 3. So obviously in this case, because they acquired that asset in 2021 year of assessment, that's why you notice, of course, that was their year 1. So hence they took the 27,000 multiplied by 50% to give you that 13,500 that you saw there. Right. So colleagues, that was just as a quick recap on what we covered on previously in lecture 12. So, but I wouldn't want to repeat things that I've already addressed or that I've already taught you guys on. But what I would like to endeavor to do, I want to try and cover base with you on the capital allowances that is applicable to building. Capital allowances that is applicable to buildings. So I want to put up some bit of summary here for you so that you guys have a bit of a better understanding, right? So now I'm going to just explain this as properties, because what they would do in the context of an exam, they would give you an explanation about a property, a particular property which the taxpayer owns. Now, a property in the context of tax, all right, it will consist of two things. It will usually consist of land and the buildings. Now, because a property consists of land and buildings, for capital allowances purposes, land cannot be depreciated. So in other words, if land cannot be depreciated, it means there is no capital allowances claim allowed. So in other words, yes, even if they give you the purchase price of the land, you cannot claim capital allowances on land. Why? Because land usually appreciates in value other than depreciating or losing in value. It appreciates in value. That's land. But now with buildings would obviously deteriorate over time. So with buildings, what SARS does, they actually provide or allows the taxpayer to claim capital allowances on certain buildings. So now, what are those buildings that SARS allows you guys to be able to claim capital allowances on? Number one, they allow you to claim capital allowances on manufacturing buildings. Number two, they allow you to claim capital allowances on what they call commercial buildings. Now, the manufacturing buildings is one and the same thing as production purposes, or buildings that are used for production purposes. That's your manufacturing buildings, right? So there's what we call commercial buildings. So just to show you that 7.10.1, there's an explanation obviously about the provisions of manufacturing buildings. I'm going to deal with that just now. Then of course in 7.10.2 in your study material, they touch on commercial buildings. The third one, it's residential units. So if a taxpayer owns some residential units, there's certain building allowances provisions that SARS allows. So we're going to be looking at all these type of buildings that SARS allows you to claim capital allowances on. Now, still under these circumstances, one of the other things that you need to take note of with a building, one of the things that a taxpayer, or if they are leasing it out to a tenant, all right, a tenant or the owner of the property can decide to improve their building. So the moment a building is improved, it follows then that the purchase price or the value of the building itself would actually increase, right? So just as a note here at the bottom, one of the things I want you guys to take note of is that with buildings, whether it's manufacturing buildings, commercial buildings, or residential units, here are the things that can actually take place. So there can be additions made to the existing building structure. So what are those additions that can happen? So number one, it can be just what we call improvements made. Number two, it can also be an additional extension of the existing building, guys. All right. There are things that you come across. They can also tell you there were repairs and maintenance that took place. Now, guys, repairs and maintenance does not form part of the value of the property. So in other words, when you're calculating the value of the building, you don't add repairs and maintenance to it. Because one thing for sure, as you go through questions, you come across, information where they'll mention about the repairs and maintenance costs that were incurred, maybe to improve the value of that property, or maybe to repair some damages that might have transpired to the building property. You do not, I repeat, you do not add repairs and maintenance to the purchase, to determine the value of that particular building, right? So we're going to begin with the manufacturing building to start with, and then of course we'll look at commercial buildings and then residential units. Now, after I've discussed the capital allowances around buildings, all right, I'm going to take you guys through one of the past exam papers. So I'm going to look at question number 1 with you guys. We're going to look at question 1. That was for the October-November 2021. So this is one of the practical questions that I can discuss with you. Why? Because what you discover in this question, they do not only cover, for instance, on the section 11E, capital allowances per se, but you would also notice that there is buildings that are going to be dealt with. No wonder the rental of office space there that is being mentioned. Even if you go to information 4, I think it should be 4.1. There are buildings that the organization had during the course of this particular year of assessment. So there's a factory building, there's of course, then they talk about other assets, So these other assets that they talk about, it's obvious that there will be, on those assets, it's obvious that there will be capital allowances, which SARS would allow you to claim over those assets. So we're going to deal with those, all right? We're also going to deal with those. So this is a very good training ground just to get you guys to have a perspective of what you can expect in the context of an exam or in the context of a year test. So I would endeavor to discuss this question with you in video B. But for now, because I want to try and then cover the grounds with regards to capital allowances over buildings. So I want to try and focus on that in video A, which is this current session that I'm doing with you now. So let's start with manufacturing buildings. Manufacturing buildings, very important. Now, guys, you see, with manufacturing buildings, here's the catch, right? Because I want to try and keep things as simple as possible for you guys. So, like I mentioned, with manufacturing buildings, or like any other building per se, there can be improvements that can be made to that property, or there can be an extension of some sort, which would result in the value of that particular asset having to increase. But one of the expected things that we would observe with a building would obviously have a purchase price, or what they call the cost price, right? Now, what then SARS did, all right, what then SARS did is they allow you, so I'm talking now in the sense of the provisions for capital allowances there. So the provisions for capital allowances is on manufacturing buildings is one such that SARS would allow you 5% of the cost price of that building. So that's the capital allowances that SARS allows. Okay, so they will allow you 5% of the cost price of the building. So the next question that should come into your mind is, what is it that makes up the cost price of the building, the manufacturing building in this case? So when you're talking about the costs of the building, in this case, it can include quite a number of things. It can include the cost to pay for labor of the people that actually got involved in building that property or that structure together. Sometimes they give you those costs in a breakdown of that nature, whereby they would indicate that, okay, the labor costs incurred was X amount of money, the materials that were used was X amount of money, you know, and finance costs was this X amount of money, VAT was this X amount of money, you know, all those kind of things. They would mention them out to you sometimes. They bring it in that sense. So question is, how do you determine the cost price of the property? So it's very important, guys, to be able to take note of that. So obviously, if you go to your textbook in section 8, chapter 8, under section 8.10.1, they give you a breakdown of what can actually make up the cost price of the asset. So, but I want to try and just keep it very simple. So, but essentially, you can find out that the labor, let me just put it this way, because labor, it can be direct or indirect. So it's direct labor costs involved to put the structure together. It can also involve the direct material incurred to put that particular structure together. And then, of course, if there was any direct manufacturing overheads, they'll also mention about that. Manufacturing overheads, sometimes they can give it in that sense. All right, it will also make up to the value of that particular building. But apart from that, you get things like, for instance, whereby if you don't have the labor cost or direct material cost per se, they will tell you that, okay, you are incurring certain costs over that particular property. For instance, those costs. All right. So sometimes those costs, amongst others, could include, for instance, the capitalized finance costs. All right. The capitalized finance cost. So for instance, if ever the property has been acquired by means of a loan, it means that there will be finance costs that you will be incurring. So those finance costs would actually form part and parcel of the purchase price or of the cost price to that particular asset. Or sometimes they can just give you the direct purchase price. All right. So these are just pointers without any order of arrangement per se. Sometimes they can just give you a direct purchase value of the building to say, okay, the building was acquired for this X amount of money. So you would know that, okay, if that was the amount that was incurred, then I would need to take that value, multiply it by 5% in order for me to get the capital allowances on the manufacturing building in question. Now, the question then comes, what if we have improvements? What if we have improvements? All right. What if we have what? Improvements to the building in question. Okay, and there's a very nice summary. In fact, before I continue, I think I need to open this for you guys. Let me show it to you in the study guide for text 2601. It's a very, very, very important summary that I think it will be of value to you guys. I'm just going to quickly open that. It's actually what I used to use for my students when they were doing this module at that time. So I just want to quickly show that to you. Right, there it is. No, it's not this one. It is this. So this is just a summary about buildings, like building allowances, basically. So obviously, we do understand that with buildings, there's your manufacturing buildings. So with manufacturing buildings, just exactly what I was explaining to you guys, there's what we call section 13 queen. And what does section 13 queen state? It states that for any buildings which are used for production or manufacturing purposes, for as long as they are bought after 1 January 1989, SARS would allow you 5% per annum of that value of that building. So that's how you calculate the capital allowances for such a property. So that is with regards to manufacturing buildings. So that's exactly the same thing that you see as you go through your study materials. That's exactly the same thing that they're trying to explain to you guys here. Exactly the same thing. So the provisions of Section 13 would apply. So what does Section 13 of the Income Tax Act states? It states that for buildings that are used for manufacturing purpose, you'll be allowed 5% of the purchase price of that asset. Now the question comes, if there are improvements, just a second. So if there are improvements to the property, how do you account for those for those improvements to your property? It's very, 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 very important to take note of that, right? How do we account for the improvements of the property? So you take the costs of improvements incurred and you also multiply it by 5% in order to give you the capital allowances thereof. Because remember, like I said, the moment you incur additional costs in form of improvements, it will increase the value of the building in question. So what will happen is you would need the costs incurred, and that cost incurred is the one that you multiply by 5% in order for you to calculate the capital allowances on the manufacturing building in question. Right. So I do not now take too long there. Then I want to move on to the other building, which is what? Commercial building. So the commercial buildings, there are two things that happens. Just like your manufacturing building, SARS would allow you 5% per annum on the purchase price of a commercial building. That is under the provisions of Section 13 Queen. Section 13 Queen. So what Section 13 Queen does is, or what it states that for as long as the building is used for commercial, meaning to say it is being used for administrative purposes like offices, normal structured offices, right? What SARS does is on the property in question, if it's a commercial or administrative building, Section 13 Queen provisions would apply, whereby you'll be allowed 5% per annum on the value of that asset for as long as it was acquired after 1st of April, or rather from 1st of April 2007 going forward. If the asset in question was acquired after that period, what would happen is, all right, you'll be allowed to claim 5% of the purchase price of the commercial building in question. But then there are also other catch that you need to take into question to say, the commercial building in question that you are talking about, was it one whereby you constructed from scratch yourself? In other words, you did the whole structure, like you built the whole structure from scratch yourself as the taxpayer? Or was it one whereby you bought it from someone else? In other words, it was owned by someone else. So it's a finished property, ready for use. So if it was a finished property, ready for use, and you acquired it from someone in that state, what SARS does, here is how you'll be allowed to calculate the provisions for capital allowances on that commercial building. You would need the purchase price that you have incurred to buy that commercial building from somebody, and you multiply it by 55%, and then you apply the capital allowance provisions of 5% on that particular asset. So when you're dealing with a question where there's a commercial building, it's very important to take note or pay attention to the details. that are provided in the case study to say, are we dealing with a commercial building that is ready to use? In other words, it's something that we acquired and it was already available for use the moment we acquired that property from someone else. Or was it something that we developed from scratch? So the moment you hear that you developed the property yourself from scratch, that's the part whereby you would just need the cost price of the that particular building, and then you simply multiply it by 5%. I repeat again, if you are the one, if the taxpayer in question is the one that constructed the commercial building from scratch, here's what you do. So you take the cost price or the purchase price you take the cost that you have incurred to construct the commercial building, the total, you multiply it by 5%. Notice you will not have to apply the 55% allocation when you're calculating the capital allowances on those terms. Then another important thing to take note about commercial buildings, that is when there is an improvement done to the commercial building in question. So if you incurred any improvements to better the commercial building structure, here's what you do. You take for the portion of the improvements, you take the cost that you've incurred to perform the improvements, you multiply it by 30%, and you apply the 5% allocation of capital allowances on the commercial building, to give you the value of the capital allowances for improvements. So that's exactly the same thing they are trying to explain to you here. So obviously, when you see the allowance will be adjusted to 55% or 30%, you'll probably be confused and you'll be wondering, okay, what do they mean when they are saying, the allowance will be adjusted to 55% or 30%. So that's why you notice when I'm explaining on these things, because if I see that what they want you to deal with in text 3761, it's more of an advancement or just something that is proceeding from text 2601. That's why you see me navigating you back to text, the text 2601, just so that you can be able to see how these things connect. So you need this summary over here concerning the commercial building. So please don't forget this summary there. Then I want to go to residential units. So you also have residential units here. So with the residential units, it's simple and pretty straightforward. So what is key, guys, also very important, is dates. Pay attention to the dates that are given in the context of a question to say, when was that asset acquired? It matters. Because if it was acquired, for instance, if it's a residential unit acquired prior to 21 October 2008, these provisions of capital allowances on the residential units would not have been applicable. So in other words, there will be no building allowance on the residential units in question. For as long as the residential units were acquired prior to the 21st of October 2008, there will be no residential units, capital allowances allowed. But if it is a property which is acquired after 21 October 2008, and it's a residential unit, what SARS does, they would apply provisions of Section 13(6), right? And that portion of the Income Tax Act, it allows you to claim 5% of the total purchase of the residential units in question. I repeat again, it would require you guys to apply Section 13(6) provisions, whereby they would say 5% of the purchase price to give you the value for the capital allowance. Right, so that's this. All right, not complicated. So for the residential, okay, so tax relief in the form of an allowance is given to the taxpayer on residential units until they were acquired or erected on or after 21 October 2008. So that's exactly what they are saying to you here. It's the same thing. So it'll be 5% of that particular asset's purchase price. So remember, this is just a summary for you guys. Section 13, subsection 1, it's only applicable when you're dealing with buildings that have been acquired for manufacturing purposes. So in other words, it's a property that is used to perform production, okay? So if that is the case, what would happen is you just need the purchase price or the value of that asset building, and then you multiply the value or the purchase price by 5%. If there were improvements made, notice you just need the cost of the improvement incurred multiplied by 5%. Notice you are not apportioning further to say times 50% or times 55% or times 30% under the provisions of manufacturing buildings. You don't do that. Remember, this is where section 13, subsection 1 applies. And that's exactly what I'm just trying to summarize for you here. So the dates are also very important. I think they mentioned something about 1st of October, 1999. So for as long as the building, all right, in fact, they stated they will not be examined on manufacturing buildings erected before. So it will be always buildings that are erected after. So in other words, the moment they say manufacturing building, it follows then that that property would have been acquired after the 1st of October, 1999. Guys, dates are very, very crucial. And then, of course, the second one they're talking about is section 13 Queen, which is exactly what I was explaining to you here, which is on commercial buildings. So you need to check very carefully in the context of the question to say, is the commercial building ready for use when it was bought by the taxpayer? If it was ready for use, then here's how you calculate the commercial building allowance. You need the purchase price or cost price times 55% times 5%. But if it was something that the taxpayer built from scratch, in other words, they constructed the property from scratch, which is now used, of course, as a commercial building, then you need the purchase price or the cost incurred, you know, to construct that property, and then you multiply that entire thing by 5%. If there was any improvements to that property, you need the costs incurred for the improvements multiplied by 30%, multiplied by 5% to give you the building allowances claim on commercial buildings there. Then lastly, residential units is pretty straightforward, guys. It's always going to be 5%. So having stated all of these things, that brings us to the end of our discussion about what you call it? About capital assets. Or about capital allowances, basically, anyways. So what are we going to do now in video B? Because I've already explained most of these things. Of course, guys, with the exercises that they bring or some examples that they bring here, most of it, I would expect you guys to go through it in your own time as well, you know. But some of it, or most of it rather, I would be applying in the context of a past exam paper discussion or a year test discussion, right? So that's what I would do with majority of them. So I think without any further ado, maybe we can begin to tap into that. So in the video B, I'm going to take you guys through a past exam paper that was written in October, November 2021. We'll begin to look at question number 1 in that discussion. So thank you. See you on video B.